Imagine waking up in the morning, checking your phone, and seeing money added to your account, even though you didn't work extra hours. No overtime, no second job, no selling. Just money arriving. At first, it sounds unrealistic, because most people grow up believing money only comes from working. You work, you get paid. You stop working, the money stops too. But investors discovered something different a long time ago. They discovered that if you own the right assets, those assets can start paying you, even while you sleep. And one of the simplest examples of this is called dividends. Because once you understand this concept, you stop seeing money the same way forever.
What are dividends? Let's keep this simple. When a company makes profit, it has choices. It can reinvest the money into the business, save it, buy back shares, or share some of that profit with investors. That payment is called a dividend. So if you own shares of a company that pays dividends, the company may pay you cash regularly, usually every quarter. Think about that for a second. You own part of a business. And because you own part of it, you can receive a portion of the profits. That means investing is no longer just about buying low and selling high. Sometimes you get paid simply for owning. That's why dividend investors love cash flow. Their investments don't just sit there. They produce income.
Why would a company pay you? This confuses a lot of beginners. Why would a company give away money? Because strong companies often generate more cash than they immediately need. And paying dividends attracts long-term investors. It signals stability. Usually, companies that consistently pay dividends are mature businesses, businesses that already dominate their industry. They're not trying to survive anymore. They're producing steady profits. That's why many dividend-paying companies are large, established businesses. And when those businesses continue growing over time, their dividend payments can grow too, meaning investors may get paid more and more over the years. Not because they worked harder, but because they owned strong assets early.
The big mindset shift. Most people trade time for money. Dividend investors try to build systems that generate money automatically. That's a completely different mindset. Imagine two people. One person spends every dollar they earn. The other person slowly buys income-producing assets. At first, there's almost no visible difference. But after years, the gap becomes massive. Because eventually, the investor owns assets that keep producing cash flow. This is why wealthy people focus so heavily on ownership. Ownership changes everything. Employees work for income. Owners build income sources. And dividends are one example of ownership paying you back.
The real power, reinvesting. Now, here's where things become powerful. Most beginners think dividends are about spending the money, but experienced investors often do something different. They reinvest them, meaning the dividends buy more shares, and those new shares produce even more dividends, which buy even more shares, and the cycle keeps repeating. This creates something incredibly important: compound growth, a snowball effect. At first, the growth feels slow, almost boring, but over time, it accelerates. Because now your money is earning money, and that money is earning money too. This is why starting early matters so much. Not because you need to be rich, but because time multiplies consistency.
Common beginner mistakes. A lot of beginners chase the highest dividend yields they can find. That can be dangerous. Sometimes extremely high dividends are warning signs, not opportunities. A company must actually be healthy enough to sustain those payments. Another mistake? Expecting quick income. Dividend investing is usually slow in the beginning. This is long-term wealth building, not instant gratification. And one more mistake? Starting too late because you think you need thousands of dollars. You don't. Many people begin small. What matters more is consistency and time, because investing habits matter more than perfect timing. The bigger lesson? Dividends are bigger than investing. They represent a completely different way of thinking about money. Most people only think about earning. Investors think about building. Building assets, building ownership, building future cash flow. And eventually, those assets can help buy back your freedom. Freedom to work less. Freedom to choose differently. Freedom to rely less on every paycheck. That's why learning this early matters. Because the earlier you start, the longer time has to work for you. If this video changed how you think about money, don't just watch and forget it. Use it. Because the biggest difference between people who struggle financially forever and people who eventually build freedom is action. Small actions, repeated consistently over long periods of time. That's the real power behind investing. And dividends are just one example of how money can slowly start working for you instead of the other way around. So start learning, start building, and give your future self a chance to live differently. If you enjoyed this video, make sure to like, subscribe, and turn on notifications for more content about money, investing, and financial freedom. And I'll see you in the next video. Peace.